Hi traders, I'm Lance Beggs from yourtradingcoach.com. Welcome to the next video in our series, Module 4, Part E. In the last couple of videos, we explored the topic of trends and the means of defining a trend through either the swing high-low structure or via trend lines. Today we'll be looking at a market feature which can act as a barrier to our trend, potentially stalling it and possibly even leading to reversal. That market feature is support and resistance. Before commencing with this course, please familiarise yourself with the disclaimer at the following webpage, yourtradingcoach.com/disclaimer.html. If you're unsure about the contents of the disclaimer, please contact me via support@yourtradingcoach.com. Of particular note is the following. The information available on our website and any of our products is general comment only for the purposes of information and education. We don't know you, so any information we provide does not take into account your individual circumstances and should not be considered advice. Before investing or trading on the basis of our material, we encourage you to first seek professional advice with regards to whether or not it is appropriate to your own particular financial circumstances, needs and objectives. As mentioned though, please refer to yourtradingcoach.com/disclaimer.html for the full text. In a previous video, we discussed the concept of a trending market, which is a market with a directional bias up or down. Support and resistance are an important concept in our market analysis as they identify price levels on a chart which have, in the past, acted to halt price movement. And so we anticipate that they may again have the potential to act as barriers to our current trend. Maybe reversing it, maybe just slowing it for a period of time. We won't know till it occurs, but we do know there is potential for some influence on our trend as price returns to these areas of support and resistance. So if you're smart, you'll want to know where these areas are. So let's look at support and resistance. We'll start with support. Support is the name given to a price area which supports price or holds it up. Think of it like a floor. If you drop a ball onto a floor, it will bounce back up. A support area on a price chart can be thought of in much the same way. It's an area which, as price falls to the floor, it is prevented from falling further and in fact will have a higher probability of bouncing back up rather than breaking. There are no guarantees though with the markets, just the knowledge that this price level has acted as support in the past and an expectation that it may continue to do so again in the future. In this chart example from the British Pound US Dollar Spot Forex pair 4-hour chart, we can clearly see the support level at the bottom of the chart. At this level here shown in green, price fell to the area, finding support at 3 points on the chart. Why is this important? By recognising areas of prior support, we anticipate a higher probability of this support area continuing to display some significance in the future. So should price return to the level, we anticipate at the very least some temporary halt, if not a complete reversal. As I said before though, there are no guarantees. A support level is not a fixed permanent barrier that is expected to hold for all eternity. At some point it may well break, but until then we recognise the potential for the level to have some further influence. And so, if you recall with trends that we trust the trend to continue until it fails, we use the same concept with SR. Trust an area of support to continue to act as support until it fails. So let's define support as an area below price which has the potential to halt and possibly reverse any bearish price movement down into that area. It doesn't matter the time frame. This is a 4-hour chart showing support, but you'll also see support on daily charts. The support area providing a floor at this level here, currently defined through 3 touches at these points here. And so we expect the support level to continue to act as support in the future until it proves otherwise. Hourly charts, the support area providing a floor at this level here, currently defined through 4 touches at these points here, and again an expectation that it will continue to act as support in the future. 5-minute chart, support area, defined by 3 touches, and once again an expectation that this level will continue to act as support for our Euro-US dollar 5-minute chart in future. And even 50-tick charts, support area defined by these touches and an expectation that it will continue to act as support in future. In fact, support is a feature of price action that you'll find in all markets and all timeframes and all chart types. Now, if you follow support, you'll find resistance really easy. It's just the opposite. Resistance is the name given to a price area which resists price or holds it down and prevents it from moving higher. Think of it like a ceiling. If you throw a ball against a ceiling, it will bounce back down. A resistance area on a price chart can be thought of in much the same way. It's an area which, as price rallies up to the ceiling, is prevented from rallying higher and in fact will have a higher probability of bouncing back down rather than breaking. There are no guarantees though with the markets, just the knowledge that this price level has acted as resistance in the past and an expectation that it may continue to do so again in the future. In this chart example from Euro-US dollar spot forex pair 4-hour chart, we can clearly see resistance level at the top of the chart, here. Price rallied to the area, finding resistance at these 4 points on the chart. So why is this important? By recognizing areas of prior resistance, we anticipate a higher probability of this resistance area continuing to display some significance in the future. So should price return to the level, we anticipate at the very least some temporary halt, if not a complete reversal. Again, like support, there are no guarantees. A resistance level is not a fixed and permanent barrier expected to hold for all time. At some point in the future, it may well break. But until then, we recognise the potential for the level to have some further influence, and so we trust an area of resistance to continue to act as resistance until it fails. So we can define resistance as an area above price which has the potential to halt and possibly reverse any bullish price movement up into that area. It doesn't matter the time frame. This is a 4-hour chart showing resistance. But like support, you'll also see resistance on daily charts, as shown with the resistance level here, formed by these touches here, and an expectation of continuation in future. Same for hourly charts with our resistance and these points here, and continuation in future. 5-minute charts, and again with tick charts. In fact, like support, resistance is a feature of price action that you'll find in all markets, all timeframes, and all chart types. Alright, I mentioned before that support and resistance are not permanent fixed barriers. They do break. And so there is an important concept you need to understand when they do break, which is called a change of polarity. And that is resistance when broken becomes support, and support when broken becomes resistance. Let's look at each in a little more detail. Firstly, resistance becomes support. Here we have a resistance level, and the concept is nice and simple. We see here in the diagram that when that resistance level breaks, it then continues to be relevant to our price charts by acting as support. Prior resistance, when broken, becomes support. And here we have an Aussie dollar, Japanese yen daily candlestick chart. The left-hand side of the chart shows resistance at approximately 86.40 before price breaks out above the resistance level at this point here. Note the price acceptance as the breakout holds above the prior resistance level for the next half dozen or so candles. And then we get a change of polarity as the prior resistance level now becomes support. The prior ceiling now becomes the floor. And in a similar fashion, we have the opposite effect. Prior support, when broken, becomes resistance. Here we have a US dollar, Canadian dollar hourly chart. The left-hand side of the chart shows support at approximately 99.55 before price breaks below the support level at this point here, and we get a change of polarity as the prior support level now becomes resistance. The prior floor now becomes a ceiling to restrict higher prices. So when a level is first broken, don't immediately exclude it from further consideration. Resistance when broken may still act as support, and support when broken may still act as resistance in all markets, all timeframes, and all chart types. So how do we identify our SR levels and how do we mark up our charts? We'll cover this topic in several parts. We'll start by looking at the process, but then follow it up with some questions that will fine-tune our understanding. How many swing highs or lows are required to define a level? Is SR an exact price level, or how close is acceptable? What time frame should we use to define our levels? What can we do when there are too many levels and our charts are really congested? When should we remove levels from our charts? And we'll discuss potential variations to the above because nothing is fixed in stone in trading. First, let's look at the process for identifying and marking up our SR levels. We'll start with identifying support. We simply look below current price to identify approximately equal swing lows that have not yet broken, and approximately equal swing highs that have been broken only once, or a change of polarity. So upon opening a blank chart, identify the current price and look downwards. Here we find two swing lows at approximately the same price level, which nicely define an area of support. There are no other areas showing lower on this chart, but if we wanted to, we could compress the chart data or scroll further back in the data to attempt to identify the next level below. We then look for prior resistance, which may now act as support. We find that by identifying swing highs, which previously formed resistance but have been broken just once. I'd be quite happy to identify this prior resistance as potential future support. And in fact, you'll see that it already has been tested twice since breaking. So this is a valid support level, as is this one, closer to current price levels. Okay, let's move the chart a little to give me some room. Having identified our support levels below price, we now project them forward, and we trade with the expectation that these prior proven levels of support will quite likely have some further influence again in future, should the market return to these levels. Identifying resistance is just the opposite process. Look above current price to identify approximately equal swing highs that have not yet been broken, and approximately equal swing lows that have been broken only once, that is, a change of polarity. So upon opening a blank chart, identify the current price level and look upwards. Here we have several swing highs, all at approximately the same level, defining a resistance level. We could also scroll back further in our data if we wished. There may well be another level even higher, but on this chart, this level is clearly defined as a level of resistance. And in addition to our higher line, we also see that we have three areas of prior support which have since been broken. This is also now an area of potential resistance. Prior support, when broken, becomes potential resistance. And so having identified our two resistance levels on the chart, let me just reposition for a sec. We then project our resistance levels forward in time, in expectation that they may well continue to have some influence in the future. Some questions though to fine-tune our understanding. Firstly, how many swing highs or lows are required to confirm a valid support or resistance level? While you will see some variation amongst experienced traders, the most common answer to this question will be 2 swing highs or lows are required to define a support or resistance level. At this point here, the chart at the top left only has one swing high defining the high point. We cannot yet mark an area of resistance. And the chart at the bottom right has only one swing low at the bottom. Again, we cannot identify a support level at this point. Support or resistance require 2 swing highs or lows in order to confirm a level. Moving forward in time though, the chart on the top left now shows 2 swing highs at approximately the same level, sufficient to define our resistance level. And the chart on the bottom right shows 2 swing lows at approximately the same level, sufficient to now define support. Next question, is SR an exact price level, or how close is acceptable? Do the swing highs or lows have to touch exactly to that price level? The answer is, think of SR as an area, not an exact price. Something like this might be more accurate in defining a whole area. But for convenience sake and to keep our charts a little less cluttered, we typically just use a line of best fit. You should recall this concept from the trendline video, which also discussed the use of a line of best fit. Brief excursions beyond the trendline were acceptable. And the same applies here. You'll note that both swing highs have tails projecting up above the resistance level, and this is fine. Brief excursions beyond the support or resistance level are acceptable. In fact, closes beyond are also acceptable, provided there is no price acceptance beyond the level and the break is quickly rejected. Draw a line of best fit. Often it'll be up against the tail extremes or the candle bodies, whatever looks to provide the best fit, but never forget it's an area, not an exact price. This causes all manner of problems for new traders who want to find certainty within the price charts. Unfortunately, for most of us, it doesn't sink in though until we've experienced a couple of hundred charts and we finally get the concept. If you find you have trouble with this concept, trust that all you're lacking is experience, and that will come. Again, looking this time at an example showing support. At the first touch, we have a tail extending beyond the level. Absolutely fine. At the second, we actually have a close just beyond the level. Once again, that's fine. The break is immediately rejected on the open of the next candle. And the third swing low, you'll note that it doesn't quite touch the level, but remember, it's an area, not an exact price. And a gap such as this, being only a fraction of a typical candle range, is absolutely close enough to be considered a touch. SR is an area, not an exact price. The third question we had in identifying SR and marking up our charts is, what time frame should we use to define our SR levels? This example is the daily chart, but as we saw earlier, support and resistance can be found on any time frame. The answer, well, again you'll find variation amongst traders, most commonly fitting into one of two options, either the trading time frame or the higher time frame. It's personal preference as to which you choose. Those operating off a single time frame approach will obviously use the same time frame they're trading on, while those who operate with a multiple time frame approach will more typically use the higher time frame. Now, we haven't covered multiple time frame analysis yet, but common advice is to vary time frames by a factor of approximately 5. So if you analyse your trend and make trading decisions off the daily chart, you might use the weekly to identify the areas of support or resistance, 5 days making up a week. Traders on the 4-hour chart might use the daily, 4 5s being 20. We round that up to the more commonly used 24-hour chart or daily chart. Traders on the 1 hour might use the 4-hour for SR. Again, a factor of 5 would make it a 5-hour chart, but we typically adjust up or down to whatever is the closest, more commonly used time frame, in this case the 4-hourly. And 5-minute traders might use the 30-minute. There's no right or wrong. You can extend beyond the factor of 5 if you wish. For example, some traders on the 1-hour chart might like to use the daily for their support and resistance levels. What is more important is just consistency in how you do this. So find what works nicely for you and stick with it. Next question, what if there are too many levels? This is also a common problem for many new traders. They mark up every swing high and low on the chart and soon find their workspace completely congested and unusable. The answer is to just select the most obvious levels. You're getting too bogged down in detail. Take a step back away from the screen and look from a distance, or go up another level in time frame. Find the levels that are obvious to everyone, those that everyone will be aware of and watching. So instead of marking up the chart as shown here, we might be happy with something like this. Step up to a higher time frame, or just zoom your perspective out, a little away from all the data. Pick the most obvious levels that jump out of the screen at you. But those levels we do deem to be valid, how long do we keep them on our chart? When do we remove them? Project a level forward and leave it on your chart until such time as the price has broken the level twice with no reaction. So price has proven the level is no longer of interest to traders. One break with no reaction is insufficient, as prior support may still prove to be valid resistance. The level remains on our chart. But after a second break through the level with no reaction, the level is removed from my chart. And finally, variations. You will see them from time to time. Different traders have been taught slightly different approaches, or they may have found these variations more to their liking through their own trial and error. Don't be afraid to explore alternatives. What I've presented here is what I believe to be the most common approach, but it's not the only way to do it. The most common variations will be in either time frame. As we discussed earlier, some traders will prefer to find their SR on their trading time frame chart, and others prefer going one step higher to a higher time frame. Try both and see which works best for you. The other variation, particularly if you look at my work, is that sometimes if you look at the higher time frame where I've determined my support and resistance, you'll see I'm willing to place an SR line based upon just one swing high or low, provided it's a significant turning point in the market. Again, try both and see what feels right for you. This is a whole lot of info, but don't worry. There's a summary at the end, and hopefully you've downloaded the PDF workbook from my website as well, so you can take notes, and you'll have plenty of opportunity to practice. But now, the next major topic, assessing the strength or weakness of support and resistance. You should recall back in the trendlines video, we discussed a number of factors which could determine which was a stronger versus a weaker trend line. Much the same concept applies to a support and resistance level. There are several factors which allow us to determine the relative strength or weakness of a level. Time, the number of touches, the recency of the level, the volume, and the way the price behaves as it leaves the level. Time. The standard TA interpretation is that the longer a price level has remained relevant as support or resistance, the more significant that level becomes, and so the stronger the level is. This level on a 4-hour chart, tested over a 1-week period and valid for just under 3 weeks total, is not considered as significant nor as strong as these weekly chart levels tested several times over the last 2 years. Very closely related to time is the number of touches. The more times price touches a level and bounces off it, the greater the strength of that SR level. This level, with only 3 touches, is not considered as relevant or strong as this level that had a total of 7 touches over recent days, 4 of them off to the left of this chart. Recency. A recently formed level is considered more relevant and stronger than a similar level formed a longer time ago. In this example, we see a support level formed just a fortnight ago. We would consider this more relevant and stronger than a similar level that might have formed 6 months ago and had not been tested since. And volume. This is closely related again to time and to the number of touches. Greater volume at an SR level indicates greater participation by traders at that level, and so increases the relevance and strength of the support or resistance level. You'll note in this example the significant volume traded whenever price is in the vicinity of the support level. And finally, the way price behaves as it leaves a level. This is not a topic we'll be touching on till the more advanced webinars and videos, apart from listing it here. But as a quick intro, we could consider those levels from which price moved very rapidly as it left the area last time it was there to be of greater strength and therefore greater likelihood to hold when price again returns to the level. So they're the factors which contribute to our assessment of strength or weakness of a level. The time spent at the level, the number of touches, how recent was the last touch, the volume traded at the level, and the way price behaves as it leaves. The greater the perceived strength, the greater the confidence we have in the level holding. Plus, the greater the expected reaction should the level actually break. Alright, let's talk briefly about how we use support and resistance. We can consider this from 2 different perspectives, analysis and trading. Firstly, let's look at SR as an analyst. We analyse the historical movement of price in order to identify the likely future directional bias. Support and resistance levels are important because they alert us to price areas that have in the past formed a barrier to further price movement, and as such could be reasonably expected to do so again. So the first use of SR as a technical analyst is as a potential barrier to trending price action. In the Euro-Yen daily chart here, we see price has broken a prior downtrend and has established a new uptrend with higher swing highs and higher swing lows. The market is in an uptrend, and as we learnt in a prior video, we trust a trend until it proves otherwise. However, we also know that support and resistance can act as barriers to trending price action. So if we look at the higher weekly chart and identify a higher resistance level, this could be an area where we show extra caution and watch the trend more closely for clues as to whether it will continue or stall or perhaps reverse entirely. So the higher time frame gives us this potential resistance barrier shown in red. Our trend is now clear to rally up to this point, and that gives us a second use for support or resistance. Potential targets for trending price action. Looking at the actual price action that followed, we can see that price certainly hit our target region, and the resistance level offered a short period of resistance for just over a week before bullish sentiment proved too strong and price broke through to move higher. So where do we expect the trend to move to after breaking resistance? To the next resistance level, of course. Essentially, the way I like to consider it in my own analysis is that support and resistance create a higher time frame SR framework within which I trade the trending price action. Price moves within the current levels of support and resistance, and when it breaks through a level, it then moves to the next area of support or resistance. Here we see where price has broken our prior resistance. So where do we expect it to move to? To the next area of resistance, which acts as both our target for price movement and an alert for potential barrier to higher prices. And moving forward in the data again, we see that this time the resistance level actually placed a ceiling on price for about 3.5 months before it finally broke through. Now, a market may not be as nicely trending as the Euro-Yen has been lately. It may well range between SR levels, but no matter how it's behaving, trending or ranging, We're analysing and trading the price movement within the framework that is provided by the support levels below it and the resistance levels above it, and we're using the SR levels as both potential targets for that price movement and barriers to continued movement in that direction. If it helps, think of the trend as like driving on a major highway. The SR levels are like the major intersections, which are like decision points. Sometimes we'll just drive straight through them, but other times we'll be forced to slow down and give way, or stop at lights, and at other times we'll even use them to change direction left or right, or even turn around. And so the second way I want to look at support and resistance is as a trader. In particular, what SR means to us if we're already in a trade, and what they offer in terms of initiation of a trade. If we're already in a trade, just as SR provides us with good analysis targets, they can also provide targets for taking profits. So in this case, assuming we're long at this point on the chart, we might place our take profit order for at least partial profits at this point here, just short of the resistance area. Profits are taken, resistance has halted price, and we now move on to seek the next trade opportunity. From a trading perspective, SR are also useful in that they provide great locations for trade entry and stop placement. We're not really going to talk trade strategy till a later video, but as a quick teaser, there are typically two categories of trades at an SR level, those related to the level holding and those related to the level breaking. And there are two types of trades within each category. The first way that a level can hold is through a test of the level, which does not break through. These can offer trade entry triggers just inside support or resistance, allowing us to place a stop loss just on the other side of the support or resistance level. The second is the breakout failure, in which price has actually broken the level, but then the break fails. These offer tremendous opportunity. I love any setup such as this where it traps other people on the wrong side of a trade. Again, a stop can be placed just beyond the extreme point of the break, safely on the other side of the support or resistance level. And there are two primary means of attempting to profit from a break of a level. Firstly, an entry on the actual break itself. So for example here, we might enter on a break of the first candle that closes beyond the support level, or now resistance, with a stop nicely placed back above that level. And the final common method of entering around SR level is the breakout pullback. This time we don't enter on the immediate break, but rather wait for a retest of the level. These retests are a common occurrence and can offer a lower risk entry into the new breakout trend. As I said though, we're not talking trading strategy just yet, so that was very quick. The focus at this stage is just to introduce all our analysis tools. We'll get to strategy later. A key question though for both analysis and trading is, how can we know whether a level will break or will hold? Well, we can never know with complete certainty, but price can give us some good clues through a method called momentum analysis. It's well beyond the scope of an introduction to TA video series. I raise it now just so you can take note and perhaps consider some additional research if your knowledge and skill is already beyond the beginner level. My ebook series, The YTC Price Action Trader, covers this topic. You'll find it available at my website, yourtradingcoach.com. So let's have a look at some examples, and since most of the charts so far have been Forex, we'll look at a couple of futures markets for a change. Support and resistance are a valid concept on all markets and all timeframes. And we'll do this in two ways. Firstly, through opening a blank chart and identifying and plotting the current SR levels. And secondly, as a learning exercise, through scrolling back into the historical data and plotting the SR levels that were current at that point of time. We'll then move forward to examine the relevance of the levels to future price action. In particular, this allows us to learn through seeing how price interacts with the SR levels, sometimes breaking the level and sometimes just testing it. This process should be part of your study after completing the video if you're serious about becoming a trader. So let's say we're trading the E-mini S&P 5-minute chart. We might commence our session by looking at the 30-minute higher time frame as displayed here for identification and plotting of our support and resistance levels. We'll start by looking below current price for swing lows at approximately the same level. Here, here, and here. We also look for prior resistance, now support, which we find at this point here, already identified as support, and here. And we look above price for swing high resistance, which we find at this area. Our SR framework is now complete. We return to our trading time frame chart to trade the price movement within this support and resistance framework. Just a reminder, if you want to study these charts in more detail, there are PDF workbooks available for download at my website, yourtradingcoach.com, containing all the key slide images, including this chart. Here we have the crude oil futures 30-minute chart. Below current price, we have support at this level here and here. Resistance above price at this level here. And it's a little messy, but I wouldn't be too concerned if you also placed a level here, prior support, now resistance. 6E, the Euro FX futures, 60-minute chart, support here, prior resistance turns support here, and resistance above price here. 6J, the Yen FX futures, daily open high low close price bars. Based upon this chart, we have no support levels below current price, but in real-time application, we could scroll further back in time to find them, or move up to weekly charts if we really wanted to identify lower support. But resistance, we see some here, and perhaps here if you're happy to consider the early March spike to be a false break. Hang Seng Index Futures, 5-minute chart, support below price at this level here, resistance here, and here, and price support, now resistance at this level here. And finally, the Aussie SPY Futures 1-hour chart, support below price here, and here, and resistance above at this level here. Looking at our second type of example now, marking up historical data and then moving forward to see the impact. I'll just give a quick demo. This is actually a dynamic process, and so it's something that will be better done using your own market and timeframes over and over and over again until you're very comfortable with SR. For this example, we've scrolled back through the Aussie dollar, US dollar, spot forex daily chart, back to late September 2012. At that stage, we had levels above and below price as shown. Apologies for being both in red, but that's actually how I do it on my charts. I don't differentiate support and resistance through green and red lines. Feel free to do so if you like that and if you think it helps. So for now, we have red support below price at 1.0160 and red resistance above at 1.0600. Moving forward, we see both support and resistance remaining relevant through a test of support here in early October and a test of resistance here in mid-December. Moving forward again, here we see SR continuing to have further effect and continuing to hold price between the two levels, with another test of resistance in January and a breakout in early March, which was immediately rejected on the next candle. This shows the danger of taking straight breakout trades. Many of them do fail, but we'll talk more about that when we discuss strategy. Another test of resistance in April, before finally breaking through support in May. It won't always work out so perfectly when you go back to find other historical examples, but this should give you an idea of the process. Simply scroll back, draw the lines as they would have existed at that time, and move forward to see the impact they have on price. And I'd highly recommend studying the interaction between SR and price on your trading time frame as well. So here, this is the same chart, but now viewed in the 4-hour time frame, with an assumption that we're trading the 4-hour within a daily SR framework. This shows the internal detail of the breakout failure that we previously saw back in early March. So when you're going through this exercise and you find something of interest, change to your trading time frame and study it. This is how you learn to read price action. And again, the 4-hour chart looking at the final break in early May. Alright, that's enough examples or we'll be going all day. Before we wrap up this topic, there is one more thing I'd like to cover, and that's having a quick look at some alternate methods of identifying potential support and resistance. So far, the only method we've discussed, and the primary method used by most chartists, is to identify our SR levels based upon significant areas of swing highs and lows. But there are other methods which can be used in addition to or instead of the swing highs and lows. Some of the others are price action based: high of the day, low of the day, gaps, opening range. Some are based primarily upon human psychology, such as round numbers, and some are purely mathematical, such as pivot points and Fibonacci ratios. Let's look very quickly at each. Swing highs and lows have been discussed already. So the next price action method we're going to introduce is really simple, taking note of the prior day's high price and low price, and using them as potential support or resistance for the upcoming session. This is applicable to intraday traders. We see here the E-mini S&P on Friday the 13th of April. Two lines have been added identifying the low of the day and the high of the day, both as potential support or resistance for the upcoming session. As the next day develops, we see the price opened just above the prior low. It quickly broke lower, and then our prior day's low acted as resistance for the next 2.5 hours, preventing further price rally. Eventually the bulls gave up the fight and the price trended strongly down from our low of day resistance. Again, we look at the E-mini S&P, this time on 19th of April. The session is closed, so we take note of the prior day's high and low as potential support and resistance. Price opens within the prior day's range and rallies higher, meeting resistance at the prior day's high. Almost always, your high and low of the day will also be a swing high or low, so you'll likely have them marked anyway if you simply use the swing high and low method. However, for many intraday traders, these high and low prices are of special significance, so take note of them and watch the levels for potential influence on price, should it trend up or down into these areas of support or resistance. The next form of price-derived SR is gaps, which occur on charts due to market closure either overnight or over weekends. In this example, we have the Hang Seng closing here on the 10th of April and opening higher on the 11th of April. This will allow us to use the gap below price as a new level of support. As the session progresses, price closes the gap and holds nicely above the level of support. The next form of SR you might come across is the opening range. You'll find a few articles on my website about this and blog posts on my old blog. It's something I quite like for intraday support and resistance. Here we have the E-mini S&P 5-minute chart for the 23rd of April 2013. The opening range is the area bounded by the highest and lowest price within a certain period of time of the open. One typical value used for opening range, and the one I'll demonstrate here, is the 5-minute opening range. After the first 5 minutes are traded, we take the lowest price and the highest price, and then use them to form an area which we project forward. You'll see how as the day progressed, price initially fell below the opening range, rallied back to it around mid-session, where the opening range then acted as resistance, holding price down and causing it to stall for the next couple of hours. Resistance finally broke as price rallied higher, eventually falling back again to close at opening range support. You'll find some people may use a different value, such as 15-minute opening range. The concept is the same. Simply mark an area bounded by the highest price during that opening time period and the lowest price during that opening time period. Project it forward and watch for it as potential support and resistance barrier throughout the remainder of the session. Looking at an even finer detail, you can see how the key levels within an opening range area are actually the high and low price. Note here on this mid-session 2-hour period where price is trapped in the opening range. You'll see here how the opening range low initially provided resistance, with 2 candles displaying upper tails as price reached near the level. Upon breaking, the opening range low price then switched polarity, prior resistance now offering support, followed by opening range high resistance, opening range low support, opening high resistance, and resistance again before the break higher. Generally, you'll just look at the whole area as one area of potential support and resistance, but with a wide opening range, you may at times find value in considering the opening range high and low price as separate levels. Let's look at another example, just considering the whole area as one area of SR. This time we have the E-mini S&P on the 16th. Taking the high and low of the first 5 minutes of data, we project forward our opening range area, which acts as resistance on 3 separate occasions through the first 2 hours of trading, before price succumbs to bearish pressure and falls through the remainder of the day. The 26th of April, price rallies above the opening range until the final quarter of the session, when it strongly drives lower. So where do we anticipate price finding support? At the opening range. And one final example, the 1st of May. Price initially breaks below the opening range by some distance, before rallying off the lows and finding resistance back at the opening range area. Resistance can't hold though as price breaks higher, before finding support at the opening range high 3 times later in the session. News events, either planned or unplanned, can be used as support and resistance if they produce a significant reaction in price movement. Here's an example using a planned news release. This is the British pound US dollar Forex 30-minute chart at 8:30 on Friday the 5th of April 2013. The US is scheduled to release its monthly economic data related to non-farm payroll figures. This is one regular news event known to have potential to move the Forex markets. We know the news event is scheduled because part of our pre-trading routine is to check the economic calendar for the timings of any potentially significant news events. As you'll see here, the economic calendar for Friday, April 5th at 8:30 a.m. lists, among others, the non-farm employment change, otherwise known as the non-farm payroll. On release of the non-farm payroll data, price rallies almost 90 pips over the next half hour. And the point of initiation of the news event can be marked as potential SR. So at this point here, we mark an area of potential support. And as price moves forward in time, we see the level acting as support at some time in the following week. A further type of SR used by traders is significant round numbers. So in Forex, this might be the 100 levels. In low-priced stocks, it might be each dollar value. In high-priced stocks, it might be each $10 value. So any value that's a nice round number. This chart is a British pound US dollar 5-minute chart. Price is trending downwards. There are no price action based levels below. So where can we expect to find potential support? In this case, we should be aware of the round number level, 1.5200. I don't know of many traders who actively mark these round numbers as levels on their chart. I guess there are some, but certainly most traders will at least be aware of the proximity of the round number levels and their potential to act as support or resistance. And in this case, as price moved further forward in time, we find that the round number level nicely halted the price move, confirming the level as a source of support. So we now move on to mathematical methods of defining potential support or resistance. The first of two common methods we'll discuss is pivot points. In this example, we'll use the E-mini Dow 5-minute chart from the 16th of April 2013. This day has now closed, and so we'll take note of three key figures: the high of the day, which occurred at 14,753, the low of the day, which occurred at 14,505, and the close at 14,515. We take these figures, the high, low, and close, and use them to derive values for a price level called the pivot point, which is simply an average of the three values, high plus low plus close, divided by 3. We then also do mathematical calculations for two higher resistance levels, R1 and R2, as shown, and the same for two lower support levels, S1 and S2. As the market opens the next day, you'll note that we have levels added for the pivot point here, and for R1 at this point here. R2, S1 and S2 are also added, but will be above and below this chart respectively. And so moving forward to the end of the day, we can see here how the pivot point acted as support at this point here, and the resistance level R1 acted as resistance at this point here. S1, S2 and R2 of course played no part on this day, as price did not travel that far, essentially producing a quite narrow range session. And the second mathematically derived method of SR is Fibonacci ratios. For this example, we'll use the Aussie dollar Japanese yen Forex daily chart. We see here that price has trended downwards over the last 2 months and finally formed a potential bottom. Fibonacci ratios are a mathematical method of determining potential support or resistance, in this case resistance, as we seek to answer the question, how high should the pullback rally go before it finds resistance and turns back down again? So we follow these steps. Identify the last swing high and the last swing low, and measure the distance between them in terms of price change. We then create Fibonacci levels between the swing high and low based upon potential retracements of the following values: 23.6% retracement, 38.2%, 50% and 61.8% retracement. So we now anticipate potential retracement at these levels as price rallies from the swing low. And so we see here in this example, the subsequent price action did find resistance in the vicinity of the 61.8% Fibonacci level. So that's a real quick introduction to many other methods that you'll see applied by traders in attempting to identify future potential support or resistance. Each of these subjects can be explored in much greater detail. If any of the methods particularly appeal to you, you'll find much information online. Explore and learn at your own pace. Perhaps in the future I'll do a video on each, expanding upon the topic. There are, of course, others you may come across, market profile for example, but it's well beyond the scope of an introduction to technical analysis. The key methods, in my opinion, are the price action methods, as they're based upon objective evidence of levels which have acted in the past to influence price. I'm personally not a fan at all of mathematical guesses as to potential SR, but there are traders who operate with pivot points or Fibonacci ratios quite successfully. In my trading though, you won't ever find them used. One final point on this, regardless of the method used, it is important to always remember that SR levels projected forward are not a guarantee to hold or reverse price. SR levels projected forward are potential levels of future support and resistance. We're simply identifying areas of interest where we watch price closely as it interacts with that level. For clues about the sentiment driving price movement, for clues about the future market bias and direction, and for clues as to potential trade opportunity. Okay, it's homework time. I know you love it. The fact is that what I can teach via these videos is a minuscule, tiny fraction of what you'll learn through getting into the charts and seeing this for yourself. So after we wrap up this video, open up your trading platform and explore. Use current data for several markets, at least half a dozen. Practice identifying the current SR levels, maybe the next 2 or 3 above and below current price. Don't forget the change of polarity levels and mark up your charts. When you're comfortable with this, delete these levels and scroll way back into the historical data. Pick some point in time and mark the levels that would have been relevant at that time, and then move forward in time to examine the price interaction with these levels. Did the price hold or break the level? Study it, consider printing it out, and building a database of levels that broke and levels that held. Build experience in reading price and identifying clues as to potential break. Note as well how you would adjust the levels if they needed adjustment, and when you would remove them from your charts. Alright, let's wrap it up with a quick summary. We started by defining support as an area below price which has the potential to halt and possibly reverse any bearish price movement down into that area. And resistance as an area above price which has the potential to halt and possibly reverse any bullish price movement up into that area. We discussed the concept of a change of polarity. First, resistance when broken becomes potential support, and support when broken becomes potential resistance. We discussed the process used to identify SR levels on our charts and to mark them up, and we considered some questions that will fine-tune our understanding. How many swing highs or lows are required to define a level? 2. Is SR an exact price level? No, we consider SR to be an area, not a fixed price level. What time frame should we use to define our levels? Either the trading or higher time frames. Neither is better, just choose the one that best fits your style of trading and be consistent. What do we do when there are too many levels and our charts are really congested? Zoom out a little, take a wider perspective, and remove all except the most obvious levels. When should we remove levels from our charts? When they fail to produce any reaction when broken on 2 occasions in a row. And we discussed potential variations to the above, in particular with the number of swing highs or lows required and in the use of time frame. Recognizing that not all levels are equal, we discussed some of the factors which allow us to assess the strength or weakness of a level. The time spent at the level, the number of touches, how recent was the last touch, the volume traded at the level, and the way price behaves as it leaves that level. We discussed the way that support and resistance are used within our analysis to provide potential barriers to our trading timeframe trends and potential analysis targets should price break the level, essentially setting up a higher timeframe SR structure within which we trade our trading timeframe trend. And for trading itself, we discussed the fact that they can provide a good method of targets for taking profits in our trades, as well as great locations for entering trades and positioning stops. And we discussed very briefly the ways that SR can provide trade opportunity through both the level holding and through it breaking. Much more on that to come in future videos. And we wrapped up with some consideration of alternate methods of displaying support and resistance, some price action based, others psychological, and others purely mathematical. It's been a long video, and yet we've only skimmed the surface of the topic. I've had to leave a lot out, and the fact is I could have made it probably 5 times as long. Really though, you've got the basic concept, and the best method of learning is to get onto the charts and experience support and resistance for yourself, so please do it. But when you're ready to explore the topic in a deeper capacity, there are some advanced TA topics you might want to research. I'll be looking at these in future via my Advanced TA series of videos or webinars. In particular, an in-depth study of how the psychology of traders creates the support and resistance levels and what that means for our analysis and identification of trade opportunity. We'll look at how to examine the bullish or bearish pressure within a price trend, learning to see signs of strength or weakness within the price as it trends and then as it interacts with SR. We'll examine the difference between supply and demand levels and support and resistance levels. A lot of people use the terms interchangeably, but there is a little difference and it's very important. And we'll examine the fact that random levels can also appear to have impact upon future price. Why is that? And what does that mean? Anyway, more to come in future. For now though, we're continuing with the Introduction to Technical Analysis series. Coming up next, Module 4, Part F, in which we start our exploration of charting patterns. You'll love this one. I'm Lance Beggs from yourtradingcoach.com. If you find value in these videos and want to be first in line for the new ones, please click on the YouTube subscribe button. And if you'd like to see more of my work, go to my website yourtradingcoach.com and sign up for the free newsletter. There's new articles on usually a weekly basis with an emphasis on discretionary price action analysis. Thank you and happy trading.